All right. Hello, everyone. How's it going? Welcome back to another video. Today, we're going to be talking about chapter 3.3 of business management, which is the break-even analysis. For this explanation specifically, I figure that the best example would be a visual one. I'm unfortunately not in my school at the moment, so I didn't have access to whiteboard, so I figured screen recording is the next best thing. Anyways, that's what we'll be doing today. This chapter really is just focused on the break-even analysis. So we'll have the focus there. However, before we get into that, there's two formulas you do have to know that are also part of this chapter that are relevant pieces of information and also just good to know them for the exams. So these are the issue of contribution. So contribution, what is that? That's basically saying total revenue once you take away the variable cost. So the pure money you're making off of the sale of a product, but it doesn't take into account any other expenses. All right, it's just the revenue of the product. So let's say we sold a hamburger. The hamburger cost $1 for the other person to buy, and for us it cost us 5 cents to make it. Well, then our total contribution from that hamburger is going to be 95 cents, because that's the amount of money that we're making directly off of that hamburger. That's the money that's coming in. Taking away what we had to spend, that's the money that hamburger brought us. But now we got to subtract all the other costs, the rent of the restaurant, the franchise fee, all the other stuff. So total contribution, that refers to as a mass. Well, let's say we sold 1,000 hamburgers, we made 95 cents on each of them, well, that's $950. That's the total contribution. Then the contribution per unit is talking per hamburger, how much money did we make? And it's the same formula. So these are both formulas for it, but they're quite simple. Anyway, so with that, that brings us to the graphic you guys have in front of you, which is the break-even analysis. Say hi. It looks complicated, but it isn't. It is not very difficult, I don't think. The problem with this graphic, and I was looking online for a lot of different graphics, and I couldn't find one that represented all the different points on a break-even analysis that I needed it to. So I'm gonna have to get a bit creative and just show you guys with my cursor here where some stuff is. But this has all the basics that you really need. So this right here is a very basic break-even chart. Or break-even analysis. So what is this? A break-even analysis is analyzing with a specific product up to which point you need to get so that a firm will be profitable. Okay, or so that it will at least make back the money that it's spending. So we all know that firms have two types of costs. This we talked about in the last chapter. They have fixed costs and variable costs. Fixed costs are always going to be the same because there's things you have to pay just to have the firm. For instance, you're going to have to pay rent. You're going to have to pay salaries. You're going to have to pay those kinds of things, health benefits. You're going to have to pay those no matter what. So before you've even sold a single unit of your product, you're going to have spent a good amount of money. And then with each product you're selling, you're going to have to spend a bit of money to make each unit of the product. So this is basically saying, we'll take into account all the costs that we're going to have just built up on the front end. How many units do we have to sell so that it compensates those fixed costs and the small variable costs so that we're at least making our money back? Break-even points or break-even is really what you're trying to get to so that your firm's at least making money. So what you see here in the middle, this little dot, this is what's known as the break-even point. This is a very important point. We're going to come back to it. So what is this graph showing? Well, so this orange line you see right here, these are costs. The reason why, because this isn't just an axis of a chart here. This is the axis of a chart. The reason why this doesn't start at zero is because this point right here is where our fixed costs are. So no matter what, that's why you see this little bracket here. This is fixed cost. So up to this point, these are your fixed costs. This is your rent. These are your salaries. These are your whatever. You're starting at this point, no matter how many units you sell, because now you can see the bottom axis. This is how much you're selling. Okay. So this is at 0 units. You're already spending this much money. And then as you sell more units, well, obviously variable costs go up. So this line starts to gradually move in the upward direction because you're spending money. So it's going to keep going up. Then we get into, and you see here this bracket saying variable cost. So everything above this line is all variable costs that are getting added on to the fixed cost. So you're always going to have these fixed costs, and as you sell more units, your costs are going to be going up. However, you'll notice this blue line is going up a lot quicker. That's because the blue line is representing the amount of revenue that you're making, the amount that you're gaining from this. And so as you can see, it starts at zero. If you sell 0 units, you make $0. There's not really a way to get around that. So this starts going up as you're selling more, you're making more money. And of course, this here is assuming that you're selling your product at more than you're making it for. You're selling it for some type of profit. So you're making money, and eventually you get to the point where the amount of revenue that you've made off of this product overcompensates your costs. This is talking your variable costs and your fixed costs. You get to this point, your break-even point. This is, let's say you've paid $100 in rent and you're paying 5 cents for every hamburger. Well, how many hamburgers do you need to sell so that you get past that point where you're making more than the money that you're having to spend? So you're making more than those first $100 plus the 0.5 or the 5 cents that you're spending to produce each hamburger. Because the variable costs, they crawl up, but they crawl up slowly. The idea is you have a good margin, right? In an ideal firm, you have a good margin, so you're making more money that's going more and more kind of beyond that. So that's really the basics of this. Is so below this point, whatever units you sell, let's say, I don't know, this represents 50 hamburgers. Well, here I'm losing money because my variable costs have gone up enough, and also with my fixed costs, I'm not making anything. So if you're in this zone, and actually like anything under here, this means you're losing money. Anything under this line in this zone of the chart, this means you're losing money. Once you get to this point, this is finally when you've sold enough units that the profit is outweighing the amount of money you're spending. So this is when you're starting to make money. If you're perfectly at this point, this means you're making $0. You're making exactly what you need to keep the business afloat, no more, no less. This means you're making profit. And now this is where we get into where this chart is lacking, because this chart, I've described everything that's on there. However, there are still a few aspects that we need to take into account. So what we have here, this is known as the break-even point. This is also the break-even quantity, because this is the number of units sold. Just imagine there's like a line here drawn down to the units sold section. So this is how many units you would have to sell to get to that break-even point. So just along this axis, if this was numbered, here, this tells you how many you need to do this. So in most cases, you're not going to have to calculate this information. Most likely what will come in an exam is they say, hey, make a break-even analysis chart for this company. And they're going to give you all of these figures for the most part. So you're just going to have to know, where do I put everything to make this chart correct? So you guys already know, your fixed cost, if they say it's, $50,000, you're going to put this here, say 50,000, and then start, drawing up. And all this is going to be approximate. In very few cases in an exam are they going to be like, hey, you need to be exact. All this information has to be exactly correct. Anyway, so this is the break-even analysis point, all right? And this is here the amount of revenue that you're making at that break-even analysis point, or this break-even point, sorry. So you're also going to have a line here. This is the amount of revenue you're making at that point. So that's kind of the basic part. And then you get to what is known as the margin of safety. So this is your sales volume minus your break-even quantity. This is to say, let's say this quantity right here is 100, and you've sold 150 units. Well, then, so all this area right here, this is known as your margin of safety, because this is how many units you've sold beyond the break-even quantity, how many units you have beyond what you needed to have sold just to make your money back. So this is expressed as a percentage of your demand. In this case, it would be 150%. Maybe, I guess, 50%. I don't know which one you're supposed to use. I think it's just 50%. So you sold 50% more than you needed to sell, so that you could make that money back. So that's this part, is this is your margin of safety of once you're beyond this point, how safe are you? If you've only sold one unit beyond the break-even quantity, then your margin of safety is very, very small. But if you sold, let's say 200 and you only had to sell 100, well, then you have a very large margin of safety because you sold far beyond what you had to sell. This also is used to evaluate the risk of degree for a product, because if you look at a product and see it's barely beyond the margin of safety, that means you really have to work hard to maintain your market, because if you lose anything, you're not going to be able to make your money back. But if you have one that's far beyond that break-even quantity, that has a very large margin of safety, that means it's quite a safe product. Then you have the target profit. So this is more how this can be used as a tool in the case of a business. Of say you say this is the break even point. Say you say, all right, with this hamburger business, I want to make $10,000. Okay, well then you can look at in what part of this graphic is the profit $10,000. So one point, so because you can see, like as we're getting here, we're $1 or $2 above, So you just keep going until you get to the point. All right, where does this line get to 10,000? Or where's it 10,000 above this? Sorry, that's the important part because these are your costs. So at what point is this 10,000 greater than this? So once you find that point, let's say it's here, well then you line it up and you say, all right, this is the quantity that of units I'm gonna have to sell to make $10,000 in profit. So that's a target profit. That's how you can use this as a tool. Is basically say, all right, at what point is this whatever amount higher than this? And then that's how you know. That's how you can kind of calculate this. Because let's say, all right, we wait until this gets to 10,000, or sorry, 20,000, and this is 10,000. All right, then we have 10,000 in profit. That's what we want. All right, we need to sell that many units. And so you can target your business strategy around those things. However, this depends on a lot of different factors because as you guys can see, this is a very one-dimensional type of graph. It depends on your risk, your pricing, level of demand. Obviously, if there's not demand for the product, none of this matters. Also, pricing strategy and pricing elasticity. Because imagine, let's say right now you have your hamburger that you're making for 5 cents and selling for $1. Okay, fantastic. But then all of a sudden, let's say there's a new competitor in town, and now you have to lower your prices to 50 cents per hamburger. Well, now you've just cut your profit margin on each hamburger in half, which means all the calculations you change. So this calculation is depending on, all right, we're going to make this amount of money, but if that changes, then we're going to have to see, all right, how does that affect things? Also, you have to take into account how would changing the price of a strategy, because what price elasticity is if I change the price, how will demand respond? Will it respond a lot or respond very little? Because that also impacts, because let's say we lower the profit margin, but if the units sold are going to go way up because the demand's going to increase once we lower this price, however amount, well, then that's a worthwhile thing because you could say, well, in that case, even though I'm making less money per unit, I'm still going to make a larger profit because I'm going to sell a lot more units. So that's working with more projections. Okay. Anyway, so break-even point, as we've said, this is when your total costs and your total revenues are the same. Your fixed costs and variable costs are the exact same as the amount of money you're making. And the break-even quantity, that's how much you need to get there. So, and anyway, so that's really the majority of this chart. Really the highest or the most complicated point that we get to is up here. So let's say at the end of the chart, this is when you're at your max profit at your full capacity. This is when you're at your full capacity of units sold. Typically, all right, your max output, if you're not told anything in an exam, you should just say it's double whatever the break-even point is. So that's why you say this is about halfway through the graph here, this point, because once you get to here, this should be roughly double. Unless they tell you otherwise, the maximum output of a company is 2 times its break-even point. Or break-even quantity, sorry. And then this is the amount of profit you'll make at that maximum. So this is in theory the ideal point of a company, is that it's making its max profit at its max output. So that's this like end part of the chart. It's like this part is kind of your max output, max profit you're going to be making. And that's the final part of this chart. And then usually, you'd have like a line drawn down here to this part saying like, all right, this is your max output, this is your break-even output, things like that. Anyway, and with that brings us to the end of the explanation. I hope everything's been understandable. If you guys have any questions, do leave comments below. It would be nicer if I had a more complete graph. The thing is, I actually have in my notes, I don't know if you guys will be able to see it very well, but I have in my notes a more complete graph. But unfortunately, since I record all these on my webcam, I did not have the ability to show my page on my notebook, because I can't angle this thing down. So, because if I did, I would have just showed you guys that. But things as they are. So I hope you guys have enjoyed this video. The last part is just kind of an analysis of what is this break-even analysis good for? Really what it's good for, well, it's good for analyzing single product firms. That's to say a company that produces one product. If we have a hamburger restaurant, it's a restaurant that only sells hamburgers. It's great for that. The problem is this doesn't take into account multiple products. Because you can see here, this is really focusing on the output and the revenue of one product. It's really hard to use this if you have more than one product that you're selling. Also, this assumes that your fixed costs are paid regardless of your output, which is like normally a logical assumption, but you have to remember part of your fixed costs are your salaries. And if you're a hamburger restaurant selling 10 hamburgers, you're going to have fewer employees than a hamburger restaurant selling 1,000 hamburgers. Naturally, because you need more people to have a higher output. So your fixed costs actually will increase a bit with higher output because you're going to need more personnel. Maybe you need a larger location, so you're going to have higher rent. So the fixed costs aren't really as uniform as the name implies. They can change with output. So this saying that, all right, fixed costs are always going to be here. Well, actually, no, this could start going up a bit more because let's say once you're at this maximum output, you need a building that's twice as large and you need twice as many employees. Obviously, not everything scales up the same way, but you're going to need more so the fixed cost can increase. This also doesn't factor in any type of pricing strategies because let's say maybe once you're selling a higher input, then you lower your profit margin, you sell it for less money. Doesn't take into account bulk orders. Because let's say if I'm ordering, I gave this example earlier in a previous video, I think, but if you order 1,000 hamburgers versus 100 hamburgers from your supplier, you might get a discount on those 1,000 hamburgers because it's a larger amount. In that case, your variable costs go down because now maybe instead of paying 5 cents per hamburger, you're paying 3 cents per hamburger. Well, then that also changes these calculations. And this is a very linear graph. It's just thinking that your variable costs are increasing in this nice straight line and your fixed costs are staying the same, and that's not really the case. Also doesn't take into account economies of scale. That's to say that once you have a larger output, your variable costs tend to decrease. Or just your overall cost relative to the number of units that you're producing tend to decrease. So really, again, this doesn't take into account this because it assumes your variable costs are going to increase. You're going to spend 5 cents for the first hamburger and 5 cents for the 1,000th hamburger, and there's nothing in middle happening that's more complicated. And it's really not, again, it's not that simple. There's going to be a lot of different factors. However, in most exams, knowing this simple part is enough. And actually, there might be a question where they ask you, hey, what are the limitations of a break-even analysis? And in that case, good to know so that you can answer those. So that's the problem. Is this graph is just very two-dimensional. It doesn't take into account all of the factors, holistically of a business that could need to take into account. But that said, that's all for the break-even analysis. I hope you guys have enjoyed this video. I hope it has been all as understandable as possible. Make sure to leave a comment if you guys need more information. And that is all. Thank you for watching and a lot of luck with your studies. See you later.